we are joined now in studio this morning by Shane Tobin, who's CEO of TrueWealth.ie and lowquotes.ie in Portlaoise, who is a qualified financial advisor for your Finance Matters segment even. So if you have a question, something you're maybe deliberating about, what should you do with your money, be it savings, investments, whatever it may be, do send it in to me now. You can call 0818 300 103, text or WhatsApp us on 083 30 10 103, or you can email to studio@midlands103.com. Shane, good morning.
Good morning, Sally-Ann.
I suppose we might just mention briefly President Donald Trump, another day, another headline. What is this doing to the markets? Like, should people who have investments be a little jittery right now?
I don't know if that's exactly correct to say, but any type of movement, anything new in the markets are going to shake it up. Any uncertainty, any sign of change, and that is one thing that Mr. Trump has done. So we got a view of Trump 1.0. We have now Trump 2.0. Hopefully there won't be a Trump 3.0.
Well, unless he changes things in the Constitution. Who knows?
But the effect it's having on the markets is just around uncertainty. Some investment managers may now choose to go towards a fixed income strategy, a bond strategy, as opposed to equities. But it's creating uncertainty. It's like a tweet from Musk. If a tweet comes out, anything at all will create uncertainty in the markets. But certainly this is a significant event and it is affecting the markets.
So the only certainty we have at the moment is uncertainty, really?
Really, that is really it, Sally-Ann.
Okay, so our first question is, what am I actually investing in with my regular monthly savings plan, pension or lump sum cash one-off investment?
Okay. So a lot of people don't actually know where their pension money, investment money, savings plan, whatever it is going.
Just hoping it's going to still be there when the time comes that they need it.
They'll see it in a direct debit towards, and there's a lot of money invested in life insurance companies in Ireland with true pensions, investment plans, savings plans. But I suppose it's to have a little bit more context to what you're actually putting your money into, hard enough to earn it. So to know exactly what you're putting it into is important. So these life insurance companies will typically, in managed funds, spread your money throughout a mix of assets. These assets would include equities, which are stocks and shares, bonds, government bonds, corporate bonds, property, commodities such as gold, and cash as well for liquidity. The best of your pension funds and your investments are well diversified, but they would include this mix of asset classes.
So how do you get a sense of that if you are signing up? Say, for instance, a lot of people now, given that the mandatory enrolment is coming into play, may not have a pension.
Yes.
They're looking at things now. I mean, how do you get a good sense of how safe an investment is for where your pension provider is saying they're going to be putting it? What questions should you be asking?
Yeah, well, first thing is what is the money actually going into? And the advice is critical, Sally-Ann. The advisor that you're speaking to is critical, and their knowledge of what they're advising you on, the experience that they have. And if you think about it, if we started off with equities, we say the word equities, a lot of people and listeners, you can bet, don't actually know what the equities are and what the stocks and shares actually are. But basically what equities are, and if we can break down each asset class for people, equities are you owning tiny pieces of companies from all over the world. Those companies you might be familiar with, the likes of Apple, Google, Microsoft, Tesla, Nvidia. And in your pension investment or savings plan, you benefit from the growth in profits and the stock value of these companies. So when you're putting your money into your pension, you're basically, through a fund, beginning to own pieces of these companies. And your pension fund, your savings plan and your investment will make you money via returns in your portfolio. These equities can also be concentrated then into particular sectors and concentrated into particular regions, and that's very important.
Okay, so you could have the likes of tech, pharma, maybe a question over that at the moment, financial sector or emerging companies. So
Yes.
your money can be focused on that one particular sector.
Your money will be focused on, depending on your attitude to risk and what portfolio you end up going into, will give your exposure to those sectors. But typically it will be technological firms, it will be your pharma, your financial and your emerging companies. Now, geography has a big part to play. The North American S&P 500 is the most famous indice in the world. it is responsible for 70% of the world's global markets. So North America, Europe, UK and Asia, these equities will mimic the growth of the world's biggest companies. And that's done and measured through a benchmark called the world's indices. And the world's indices are broken down into particular regions. So you'll have, as I say, you'll have the S&P 500 that some people will be more familiar with. You'll have the Dow Jones. In Europe, you'll have the FTSE 100, the top 100 companies on the London Stock Exchange. You'll have the DAX in Germany, CAC in France, and our very own ISEC 20. So you'll have the top 20 largest publicly traded companies in Ireland. So that'll include some of the banks like Ryanair and Kerry Group and so on. The most important one probably then, Sally-Ann, is the World Index, so the MSCI World Index, which is a benchmark that will measure 1,500 large and mid-sized companies across 23 developed countries. And that is giving you a benchmark measurement of the overall performance of the world markets.
And that, in terms of your advice, that's pretty well diversified within your equities if you're tracking that particular index.
Yeah, if you're tracking that index, so diversifying your portfolio via a mix of assets, you're diversified. But if you are heavily weighted in equities, which is a play for a lot of people, the equities themselves being diversified via tracking a world indices such as the MSCI would be a fantastic strategy. And I suppose equities deserve they deserve a lot to talk about in the space, because they are the engine and powerhouse of our pension and our savings plan and our investment. And when the statement comes in the door and we look down and with delight and we see the growth in our pension fund, well, that's what we're hoping for anyway, it's usually equities at play and doing their job in the background. To give you an idea there, Sally-Ann, 10,000 invested in the S&P 500 in 1993 would be worth €200,000 today, and that'd be an average annual return of 10%.
Okay, now I'm paying attention.
I thought that'd get you all right, Sally-Ann.
Yeah, when we hear it in the numbers, that's what kind of resonates.
That's all you want to know.
But I suppose just before we take a break, key to remember, it's volatile.
The markets are volatile, and once people understand and know that, I like to explain, like a toddler going up and down in a trampoline, okay? They are volatile.
Or like a relationship.
A little bit like that. Oh, I didn't want to say that, but a little bit like that. Once your listeners and investors are aware of that and prepared for the volatility. Now, volatility is another explanation for it. Some people say risk. We like to use volatility. There is risk. The markets will go up and down. But in their history, never, ever, ever have they not rebounded from a pandemic, a recession, Trump 1.0, Trump 2.0, they will rebound again. So the markets have always come back for over 100 years.
Yeah, if you're able to hold tight.
If you're able to hold tight, exactly.
All right. Okay. We're going to take a quick break here on Midlands Today. Indeed, if you have a question you'd like some advice from Shane on, do get it into me now. 083 30 10 103, or you can phone us on 0818 300 103. We'll take a quick break. Back with more after this.
We're already putting the next Midlands Today show together. Get your topic included. Email midlandstoday@midlands103.com.
Welcome back to Midlands Today here on Midlands 103 with me, Sally-Ann Barrett. We're with you right up until 12 today. We are joined in studio this morning by Shane Tobin, who's CEO of TrueWealth.ie and lowquotes.ie in Portlaoise, for all your financial advice this morning. Shane, we have a question from one of our listeners on 083 30 10 103. I hear a lot about income protection insurance. Starting at what income is this worthwhile when one is legally single? Dole is means tested, but for me, it'll only be tested against my income, so not that of a partner.
Well, I'm assuming this person has an income here to insure. So look at income protection. There's never a case to not have income protection. I would say if there's an income at play, there is something to lose and something to protect. So you can insure up to 75% of the income that you have, your total income in the house, less the state benefit. And yeah, you can insure your income right from 4 weeks on a doctor's cert for any type of accident or illness, right up until retirement age. Another name for it is permanent health insurance. And once you take it out at the right price, at the right age, suiting you, it can never be taken away from you, no matter how many times you claim from it. So
I'm taking from that, shop around is important?
Yeah, shop around. make sure that you have the right company. Some companies will have better terms and conditions for your situation. You might have had pre-existing conditions or illnesses that need to be considered. So,
And always better to be upfront about that kind of thing, because it can nullify your policy.
I'm delighted you said that, Sally. It's absolutely crucial. There will never be a problem with a claim for income protection, just as long as the application and the questions are answered honestly and truthfully and correctly.
Okay. Just before the break, Shane, we were talking, I suppose, about investment. And I suppose given the world we're in at the moment with what's happening in the US with tariffs, etc., there's maybe a little bit of uncertainty from people. Bonds might be the safer option.
Yes. Bonds have always been an option, and they will take up some portion of your portfolio. But I suppose just to explain what a bond is and what a fixed income is for people, then again, we want people to know exactly what they're putting their money into. So a bond is basically where through a fund, the fund will loan money to a government or a corporation over a specific term in return for a guaranteed fixed income payment. Now that payment then is followed up by your investment, your original investment back at the end of the term. Although that nothing is guaranteed in that respect, that is the principle of how they work.
You're essentially a money lender on an international stage.
You're a money lender on an I've never heard it explained like that before, but it sounds a lot more glorious than the way I explained it. But you're correct, you're right. You are loaning your money through these funds into governments and corporations in return for a guaranteed fixed income. So government bonds will be issued by the Irish government, by the US Treasury. You will have the large corporations, the Apples, the Amazons. They will offer you a steady, predictable, stable income, which is very relevant during turbulent market times, such as what we're seeing right now. So for us, when it's clear that the investor is not maybe comfortable with the level of volatility that would come from a more equities-based fund, we would put a portion then of their investment towards a fixed bond, fixed income. So now that fixed income can come at a cost also, because when you're looking over the hedge at your equities performing over the period at 20% last year, 20% the year before, and your bond is returning 3%, we just wonder over the period how much it's actually costing you to smooth out that investment journey over 10, 15, 20 years. 50,000 euros invested in a 3% government bond over 10 years will give you back 1,500 a year, 15,000 in total interest, and your 50,000 back at maturity. So not as attractive as equity.
But less anxiety.
Less anxiety, lower heart rate and less ups and downs.
Yeah, easier on the heart
rate. The child is bouncing less so on the trampoline.
Okay, right. Okay, so definitely one to consider. In terms of property then, indirect real estate investment, like we see many Irish investors favour property. You know, there's a lot to be said about putting your money into bricks and mortar, or so we're told. But direct property investment can be complicated. I mean, how do managed funds provide property exposure without being complex about it?
Yes. So you can do it two ways. You can do it indirectly and you can do it directly. So if you're investing in your pension and your pension portion of your asset, your fund is being invested in property, that may be done through a property fund or a REIT. So your fund could be invested in commercial property like offices, retail parks, shopping centres, warehouses, industrial units, and apartment blocks through these REITs, as I say. And a REIT is just a company that invests in property, and you or the fund buys a share in that company, in that REIT, the very same as they'd buy an equity or a stock. The other side of it then, Sally-Ann, is a direct, and this is a big one for us and something that we talk about every day in our business to our clients. So you can actually go and buy a property out of your pension fund. Something that a lot of people aren't quite aware, and we'll know that from our inquiries into the office. So we love property because it's tangible asset. You can see it. It's bricks and mortar, particularly at times like this when the markets are uncertain. And you can go then and you can buy a property through your pension if your pension has enough funds in it to purchase the property. It's very, very tax efficient if you're headstrong on property. So when we sit down with a client and we assess their goals, their attitude, their investments, their time frames, what they're looking to achieve, if direct property investment through a pension is an option for them, we will just make them aware of how much of their assets are in one asset class then. So to take an investment fund or a pension fund of say 3, 4, 500,000, take out of spread diversely across thousands of companies across the world in an equities based portfolio, to then take it and put it into one property. That's the con of owning a property in your pension. So you're all in on
All eggs in one basket.
All eggs on one basket. However, it is very tax efficient. Through your pension, if you've invested into your pension tax-free via tax relief, you will have then bought the property without paying any income tax, which is delicious, I would say, right? You will then, from that point, you will receive income from that property back into the fund tax-free. The funds can actually be reinvested in the markets from that point then again. So it makes a lot of sense from a tax point of view, but it's just the con of being overly weighted in one asset class, that being property, and property being not liquid either. So to go and sell a house, it's not the same as cashing in your pension or an investment.
Yeah, for sure. It's not simple. In terms of the investment return you could expect from that, Shane, like what's the real life figures on it?
Yeah, so if we took a commercial property fund over the last 10 years, if you put 20,000 euros into commercial property, today it would be worth 39,000 euros with an investment return of 7%. That's not taking into consideration direct property investment through a pension. With the tax relief and growth, it would be much higher than that.
Okay, quickly before we go, commodities.
Yes.
Give us the lowdown on gold. Is that where we should be putting it?
So gold doesn't care if Elon Musk tweets something crazy.
Good.
And that's the main thing, and he does that. So if he gets out the chainsaw on stage, it doesn't directly affect gold. Gold has a lower correlation to the volatility of equities, and that's why you would have other commodities such as gold in your portfolio. When the equities are up and down, gold will provide a different asset class and a more stable asset class. Now, gold has done really well over the last 20 years. Gold in 2000, the year 2000, was €300 per ounce. Today, gold is €2,800 per ounce.
Wow.
So if you put 10,000 into a gold fund or a gold-based tracking indice tracking the value of gold, it would have increased from 10,000 to 67,000 euros over that period. That's just under a 10% average return.
And it's not the only commodities, like you have other examples there as well.
You'll have your silver, gas, you'll have oil, you'll have industrial metals. So yeah, they're just a different asset class, and they're just another way of investing to keep yourself diversified across all the asset class, Sally.
So overall then, is it better to kind of have a little bit of all of these?
It depends on your temperament, I suppose, and it depends on your attitude to risk. But what I'd love for your listeners to know is, if you're well diversified, you're protected. And if you want to be well diversified across asset classes, you have some equities, you have some bonds, you have some fixed income there, you have some in commodities, you have some property, and you have some cash in your fund for liquidity. But to be well diversified is the name of the game. You can also be well diversified within your particular asset class then as well.
Right, a very broad overview of where you could be putting your money at the moment. Shane Tobin, thank you for joining us this morning. Shane Tobin there, CEO of TrueWealth.ie and lowquotes.ie in Portlaoise, a qualified financial advisor, giving us a good overview of where you could be putting that spare cash, if you have any. That's the thing, isn't it? More finance matters with Shane in the coming weeks, but if you do have any question or comment, you can let us know now on 083 30 10 103, and Shane will address that the next time he's with us here on Midlands Today.